What are the tax implications when selling your HVAC business? So this is probably one of the most important things to figure out if you're going to sell your HVAC business, or any business rather, and then retire. And it's estimating how much of the net proceeds from the sale of your business will go into your pocket versus how much will go to the IRS. So I want to explain the basics of what are the tax implications when we sell our business and break down an example of how this actually works. Because if you're retiring, we need to make sure the check that you receive from the sale after taxes, fees, and commissions will be enough when combined with your investable assets to support you and your family in retirement. So here is what happens when you sell a business. The sale of a business will in most cases trigger what's called a long-term capital gain for the owner selling, and a federal capital gains tax will apply. In addition to that, depending on which state you are in, state income taxes could apply here as well. As an example, if you started a business 10, 15 years ago with an investment of $100,000 and sell it for $3 million, your long-term capital gain would be $2.9 million, which is the selling price, $3 million, minus your original cost basis, or the money you put into the business to start it, $100,000. A federal capital gains tax of 20% will apply here, reducing the net proceeds from the sale to $2.4 million and paying $580,000 in capital gains taxes. Now, there's also state income tax. So some states, they don't have an income tax, so executing your sales transaction while residing in those states could have some obvious benefits for the owner selling. And I'll mention those states with no state income tax right now. So if you're in one of those states, you'll save a ton of taxes alone. They are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. Now, back to our original example using a capital gain of $2.9 million. Let's say you live in California. They have a 13.3% state income tax rate. So between the federal capital gains tax of 20% and the 13.3% state income tax, that's a 33.3% tax. The net proceeds to the seller after federal and state taxes would be a little over $2 million. So you're paying almost $1 million in taxes, which is nuts. Now, keep in mind, this is California, which has one of the largest and highest state income tax rates. Pennsylvania, where I'm from, it's 3.07. West Virginia is 5.12. And Ohio is 3.5. So just be aware, don't forget to factor that into your estimation. Also, keep in mind that our example, we didn't include any commissions that the broker gets who's handling the transaction of the sale, nor any fees for setting up the deal. Now, for context, I'm not a broker. I don't execute these transactions. I'm a certified financial planner and help figure out what the check needs to say for an owner to retire and turn that into an income stream. But from my experience, commissions for brokers can range from 5% all the way up to 10%, depending on the complexity and size of the deal. I work with brokers to facilitate the actual transactions, so they are definitely needed for the process. And for good brokers who know their stuff, it's well worth paying the commission for them to market your business for a sale. The takeaway I want any business owner to have who is considering to retire and sell their business is to crunch your numbers and know what the check needs to say for your specific situation.